For this presentation, we'll be talking about the WorldCom scandal. WorldCom first began known as Long Distance Discount Services and was established in 1983. By 1992, Long Distance Discount Service had already merged with 35 companies. Because of these acquisitions, the company rapidly grew and its service expanded to countries throughout the world. In 1995, LDDS changed its name to WorldCom to reflect its new international status. Jack Grubman, a Solomon Smith Barney's telecoms analyst, described WorldCom as the must-own large-cap growth stock in any investor's portfolio. This helped earn himself $20 million a year between 1998 and 2001 and helped increase WorldCom stock dramatically. WorldCom CEO Bernard Evers built a personal empire for himself, starting with a cattle ranch in Canada, as well as a timber farm and a luxury yacht building company. He took one large volume of debt estimated between $500 million and $1 billion using WorldCom stock as collateral. Evers ran WorldCom like it was his own private fiefdom, decreeing virtually everything that happened within the company and tapping it for personal loans when he ran short of cash. He was also in control of company compensation and awarded over 500 key employees a total of $240 million in cash and bonuses, in addition to share options. However, as it turned out, Evers had paid too much for some of the company's acquisitions and had simply absorbed too many companies into WorldCom. When he came under increased pressure from banks to cover margins on his WorldCom stock in September of 2000, he rejected being so unscrupulous with company funds. Even when faced with possible forced liquidation of his holdings, he still asked the company to grant him a short-term loan, and the board of directors granted this request. They gave him $50 million at interest rates far below the market rates. Rather than use this money to repay debts, however, Evers used it as working capital to continue his current lifestyle. Because customer credit would reduce the company's revenue both on income statements and balance sheets, Evers decided to reclassify the credit as miscellaneous expenses. This improved WorldCom's revenue figures because miscellaneous expenses are not included in earnings before interest, taxes, depreciation, and amortization as customer credits are, thus improving the way the company's earnings appear to investors. Using shady accounting practices, WorldCom was able to consistently report that its line cost to revenue ratio was 42%, when in actuality it was 51% for most of 2001. Nearly $3.3 billion in accruals were improperly released against line cost between the second quarter of 1999 and the fourth quarter of 2000 in order to smooth them out. In total, $3.5 billion of line costs were capitalized as prepaid capacity. This is prohibited under U.S. Generally Accepted Accounting Principles, U.S. GAAP, because fees must be expensed and may not be capitalized, which made WorldCom's deceitful accounting of those line costs completely illegal. WorldCom had weak internal and external auditors. Audit committees spent only as little as 3 to 6 hours a year overseeing the company's activities to accounts, while compensation committees met upwards of 17 times per year. Sales forecasts were poorly integrated, and billing and accounting systems were largely ignored. In 1986, Arthur Andersen, an accounting firm, was WorldCom's external auditor. Andersen's was willing to compromise the signing of financial statements in order to not lose a major client who was paying high fees for audit and consulting services. Later, in April of 2002, KMPG replaced Andersen as the external auditors for WorldCom. KMPG were unable to match costs and revenues on income statements and told Andersen that capitalizations were not permitted under U.S. GAAP. On June 25, 2002, KPMG announced to the public that $3.8 billion accounting fraud was found. WorldCom's share price plummeted to 9 cents, bonds downgraded to junk bonds, and WorldCom filed for bankruptcy protection under Chapter 11 on July 21st, 2002. WorldCom had surpassed Enron and became the largest bankruptcy in history. Shareholders lost over $180 billion, and bondholders still received some stake in the company. Anderson Company was also sued in class action shareholder lawsuit for failing to detect the accounting fraud at WorldCom, which led to the collapse of Anderson. On March 15, 2005, Bernard Evers was convicted of fraud and found guilty for filing false documents with regulators and sentenced to 25 years in prison. CFO Scott Sullivan and Controller David Myers were also charged with criminal penalties and securities fraud for filing false statements. Accounting Director Buford Yates also pleaded guilty to conspiracy and fraud charges. As a result of accounting scandals of WorldCom, Enron, and Tyco, the Sarbanes-Oxley Act of 2002 was created, which forbid loans to company officers and requires company CEOs and CFOs to sign off on financial statements for certification and accuracy. In summary, we believe that WorldCom was in violation of both ethical standards as well as violating the law. Law violation was obvious as they broke many U.S. GAAP rules. And as far as violating ethical standards, WorldCom did everything in their power to give off the appearance that the company value was much greater than it really was, which drove up stock value. This in turn attracted more shareholders to invest in the company. Knowing the consequences of what could happen if caught, WorldCom leaders continued to line their pockets at the potential expense of its shareholders, which turned out to be over $180 billion.